And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. Money continues to pour into ETFs, particularly into equity ETFs, not so much into bonds, though. Let's talk with Charles Ellis. He's the author of the investment classic, Winning the Loser's Game. It's out tomorrow in an 8th edition. Dave Noddick, my old friend from ETF Trends, joins us as well. And Charlie, it's very exciting to have you on. I have known you for so many years. I've known your book for so many years. And yet we've never had you on CNBC before, to my knowledge. I found this in my library, Charlie. This was the 1998 edition of Winning the Loser's Game, which I got when I came down here in 1997 or 98 or 99. I got it, but this is the 1998 edition, and then the 8th edition is just out. Congratulations! It's a real investment classic. It has had a lot of influence on me personally. For viewers that are not familiar with your book, Charlie, summarize the findings of the new edition for us briefly. Your key points are that the evidence for investing in indexing, in particular, continues to get stronger and stronger. And can you summarize that evidence for us now?
Sure. You can look at it two ways. One is top down, the other is bottom up. Top down, you look and see over a reasonably long time period, 15 years, 20 years, how many active managers beat the market index that they chose for themselves and had free time to organize. The answer is somewhere between 10 and 15%, Bob. Only 10 and 15%. The ones that fall short by a great deal more than the ones that happen to win, get ahead by. So the odds are stacked against you very badly. The second thing you do is take a look at the data and work up from the specific facts. All kinds of changes have taken place in the investment management world. Now information is available to virtually every participant at exactly the same time in complete disclosure. So that's because of Bloomberg terminals. It's also because the SEC has made it a law for now a dozen years that if any investor gets any useful information for making an investment decision, that listed company is responsible for being sure they've done all they can to get that same information to everybody else. And when you make changes like that, it's no surprise that it's very hard for people to overcome cost of operations, the fees, and then, of course, for every individual investor, the taxes that are added on. Indexing doesn't have those kinds of taxes because it doesn't have that kind of turnover, and therefore, we get competitive advantage. ETFs and index.
Dave, any argument with that? I mean, the data, of course, is overwhelming, as Charlie says. Yeah. Morningstar does this. S&P does it twice a year, and they've been doing it for 20 years. I don't know if we can dispute any of this at all. It seems pretty clear to me at this point, but is there some finer point we need to put on this?
Yeah, I mean, just, having been a student of Mr. Ellis's book for, decades at this point, I go back to those sort of sources of active management, right? And certainly when we think about stock selection and market timing, obviously, I completely agree. The data is the data. Every once in a while, you'll end up with a rare pocket of outperformance. So, for instance, over the last 5 years, high-yield bond managers have been able to do slightly better than CoinFlip. But it's hardly, some sort of raving endorsement for the active managers in that space. But the third source of active management is that asset selection. And I think that's the one where a lot of investors are really hung up right now, particularly because a lot of the old saws, even amongst passive investors, have revolved around things like what is your equity to bond mix? What is your home bias versus your international and emerging markets exposure? And I think a lot of investors don't think of those as active management decisions, but boy, they really can be, even if you're only implementing them with low-cost passive ETFs.
Yeah. What about that? What about that, Charlie? Go ahead. Put your 2 cents in here on this.
It's really important for every single person. Active examination of who you are, what your problems are, what your opportunities are, what your resources are, how long you've got to be invested. Figure out what the problem is, and then work to figure out the solution. That is active, and it really pays if it's done carefully and well. And if you can't do it yourself, get an investment advisor who will take you through the process. That's active at its best.
Yeah, but Dave brings up an interesting point, that a component of active investing these days is to decide your asset mix. Now, you have been a proponent of broad diversification in index funds, Dave's trying to, I think, make a point that a lot of investors today have choices, particularly even with ETFs these days, so you can overweight technology stocks. You can own, recently, there's been a big craze for what we call thematic tech ETFs, which is investing in cybersecurity or investing in climate change or investing in anything that's perceived to be a growth-oriented mode. Is there any evidence that doing any kind of anything other than broad index investing outperforms at all?
None that I know of.
You know, not to get too technical on Fama French models, but there have been studies done over decades looking at factors, including value investing, small cap investing, for example, or investing even by earnings growth. There has been some evidence that value outperforms over growth. Small caps outperform over long periods, although that has not happened in the last decade or so. Are you at all supportive of any of those kinds of factor type investing?
I'm not opposed to the concept, but it requires an extraordinary amount of skill and patience because factors don't come along and announce themselves. You have to be waiting for them, waiting for them, waiting for them. And by the time other people see, oh, look, such and such a factor is really working, it's probably over. I'm not an enthusiast factor investing, but I do know people are good at it, and I'm willing to let them play that game.
I love talking to the active investment community because they get very defensive about this. I mean, they're always sort of like, what are you implying, Bob? I'm not worth the money. I work very hard. They sort of imply, well, I'll admit other people don't do very well, but I worked very well, and somehow I'm outperforming. And when you really press them, they seem to get annoyed over the idea of passive investing in general. They seem to think it's, you've heard this word un-American, that it's wrong to just be average. You're supposed to swing for the fences. And then there's the argument, well, Bob, active investing must work because if it didn't, all the active managers would go out of business. What is wrong with that argument? You make a point of that in the book of addressing that.
Well, lots of people would like to see active investing work. When I was a child, my mother read to me The Little Engine That Could. And the little engine struggled, I think I can, I think I can, I think I can, and made it to the top of the mountain. And that was wonderful for child play. And then when I was in school, I learned that if you do your homework, you're going to get better grades. And in sports, if you work harder, you'll get in better shape and you'll be able to perform better. Many of our life lessons are if you do more homework and work harder and try harder, you'll do better. And that's often true. But there are some parts of life where that just isn't the case. And candidly, in today's contemporary world, investing for most of us, active doesn't really help, and it does harm.
Yeah, and Bob, I think the other piece here is that, you know, I don't think even Charlie would say that there is no active manager who has ever outperformed. That's not the case. It's just that the average active manager consistently underperforms. But, you know, even if we think about something like U.S. large cap growth, well, there's still 10% of active large cap growth managers who have a 20-year market-beating track record. Now, we can argue about whether that 10% is coin flippers or true skill or true insight and an ability to sort of manipulate models effectively. But that's part of why we always have this hope that springs eternal, because, you know, we can line up 100 active fund managers and 10 of them, in fact, have incredible 20-year track records. The problem is finding that person for the next 20 years turns out to be a bit of a mug's game.
Yeah, it's incredible to me. You know, people ask me, well, why do people still invest in active management? Because, as you point out, Charlie, active management investment products are sold. They're not really bought. One of my favorite stories in your book, you've been using it for years, and I often tell this story about the fisherman who goes into the bait shop and he sees all of these very gaudy fishing lures sitting there, multicolored fishing lures, and he goes over to the manager and says, do any of these fishing lures actually catch fish? And the manager says, we don't sell the lures to the fish, meaning we don't have to have the fish convinced that they should bite at it. We only need to convince you, you're the fisherman, to buy into it. That's a great story. I always use that story as an indication that people are sold these products because they are sold them by people who are very good at convincing people that they ought to be buying them.
And the truth, I would like to be convinced that somebody is really so good that they'll be able to succeed. So we're guilty in part ourselves. It just, if you stand back from what people are saying and all the excitement of a particular time period and look at the history over time, you'd say there's no way that this isn't going to work out to be really hard for active investment managers on an operational level. And therefore, it's not a game I want to play. We're talking about real money. And if you're saving for retirement, or you're saving for your kids' education, or you're saving to buy a house, that's real money. It has importance for you. You ought to play sensibly with it.
Yeah. I want to just focus on the key parts of your book. Dave, I'll get you back in here in a minute. But the elements of long-term investing here, which I picked up 24 years ago when I got your book, but it's worth repeating: using index funds over active investing, broad diversification, and pay very close attention to the fees, expenses, taxes, and stay focused on the long term. And Charlie, the key message here is make less mistakes than the other guy. That's the whole point about, there's an explanation about what the loser's game is, but I don't want to get into it. But I think the key point here is focused on the long term. And the problem with investors is they get scared very easily. How do you convince people who are 55 years old and suddenly is a 20% correction to stay the course? It's that stay the course thing that's really hard.
It's very difficult. It's a real challenge, and it takes active engagement with yourself to know who you are and set up a portfolio that you can live with and accept the ups and downs. But when you look at the portfolio, don't look at it just as a securities portion, because all of us have other things that are going on. At some age, Social Security turns out to be a really important part of your total investment picture. At a young person, the really big part of everything that has to do with their finances is their ability to earn and save money in the future. And if they happen to be very talented and they happen to have good education, they're going to have a substantial capacity to save. They should recognize that and use that as part of their thinking process. Anybody who owns a home should recognize the value of the home is at least as important as the other things in your total portfolio financially. And if you look at all those other components, they're pretty stable. And when the market goes up and down, if you just keep your eye on the total picture, you're going to be much more able to stay the course and get the long-term results that come out of being a long-term equity investor.
Dave, you want to say something?
Yeah, I just would love your opinion on this, Charlie. You've talked about many times about how investing really shouldn't be entertainment, or that is actually a problematic thing. Yet it feels like over the last year, boy, investing has been entertainment more than at any time in my lifetime. And some of that may be people trapped at home, maybe with a little bit of extra capital they weren't expecting. Do you think that entertainment component is changing markets? And does it change your opinions about what to do with all?
It may be changing markets, but honestly, it has not in any way changed my opinion. My daughter is a very attractive young woman, and she enjoys going to a casino. And I know, and you know, that she's going to lose money as long as she's in the casino. But she goes for the recreational event and just happens to enjoy it. So what's wrong with that? As long as it's in small amounts of money, fine. Everybody pays for recreation and entertainment.
So let me just pick up on Dave's point here. One of your long-term points has been that the market is now dominated by professionals, by and large, and it's professionals trading with other professionals, and you can't beat that, which makes a lot of sense. But just picking up on Dave's point, recently there has been a notable increase in retail investing. We've had estimates that, we used to say the market was not more than 10 or 15% retail anymore, and there was some evidence in January it may have gone up to 20, 25%. Does that change your outlook at all? I mean, what does it mean when there's a lot more retail investors? Does that mean there's a lot of more dumb money? I dislike that word. I don't use it, but that is a word that is used around for professionals to pick off. What does it mean with the Reddit crowd being involved?
It's a game I wouldn't personally want to play, and I would certainly never recommend it to anybody else. Now, if you did want to play the game, for goodness sake, recognize that it's a fast and furious game, and the ability to understand the game and then to figure out what's the right strategy to play is really hard. So I personally would recommend to anybody with his head screwed on tight, skip it. Let other people play that game.
Yeah,
Yeah.
but I would just say it does feel sometimes like we have two markets, right? We have the fast-moving, high-energy market that I think retail investors have been playing in, and we have this longer, slower, wealth-generating market that I think Charlie and I would agree is the one most investors should be paying attention to.
Yeah. Let me ask you about reversion to the mean. You go to great lengths to demonstrate reversion to the mean. The markets have demonstrated roughly 9% returns, very long term, not inflation adjusted, maybe 7% inflation adjusted. Obviously, we've been doing better than that in the last 10 years. Are we due for a reversion to the mean, number one? And number two, what does it mean when the Federal Reserve is the marginal provider of liquidity in the market since the 2009 bottom? How does that affect stock prices? I know we talk in the traditional way about stocks are determined by dividends, earnings, and how much they're growing or not. And by the PE ratio, the multiple with a speculative component. But Jack Bogle never mentioned like liquidity, for example. So I'm asking an open question, but what does it mean when the Fed's pumping all this money for years and years into the economy? How does that affect stock prices?
Well, you got to start first with understanding what's the role of the Fed. The Fed is really focused on the economy and on people who are not at work, and at rebuilding the energy and excitement within the economy. And one way of doing that, and the only tool they've got that has real power, is to bring the cost of money down, down, down. And now the cost of money is so low that after you adjust for inflation, bonds don't pay anything. So using money to rebuild the economy is the Fed's principal objective. They don't really care at all about investors, and they shouldn't. That's not their job. As investors, we take what the Fed's doing and then try to interpret what we would do as a consequence. And when the interest rates are as low as they are, you got to think very, very carefully.
I want to get your thoughts on bonds in a moment, but I just want to pick up on this because the S&P is up 500% almost since the bottom in 2009. When I call stock traders, I say, why is the market up 500%? In addition to the earnings growth and dividend growth, almost everyone would say, well, the Fed isn't pumping money into the market. And traders have come to believe that a good part of that liquidity, that money, has found its way into the stock market. Now, nobody knows if the market's up 500% since the bottom, whether the Fed is 20% of that reason or 40%, or I don't think you can quantify that. But everyone I talk to believes the Fed is a factor in that. So I'm just trying to figure out how do you factor it in? How does that factor into the old idea that the stock prices are determined by dividends, earnings growth, and the multiple in the market? It seems like liquidity is a sort of fourth factor here that's ever present.
Well, the only thing I can suggest, Bob, is assume that you were on the governing board of the Fed. How would you vote? You're responsible for the economy as a whole. You've got large numbers of people that are either underemployed or not employed, and you want a fairly modest level of investment by major corporations. It would be wonderful to have more investment spending. What would you do? I know what I would do is just exactly what the Fed is doing. Would I be paying attention to what that means for investors individually? No, I would not, because it's not my job.
Yeah, but for sure money's gone into the market. So I guess the point that, and traders tell me this all the time, Bob, but to what extent is the Fed now permanently sort of in the market, and how do we factor that into stock prices? I'm not trying to keep repeating the question to you, but it's an issue that I get all the time. I want to get your thought on bonds. There's a new chapter on bonds. You say the traditional concept of investing your age is outdated. The old 60-40 model, stocks, bonds, is outdated. Why doesn't it work anymore, and what do investors need to do with their bonds?
The real answer is a little bit complicated, but not very. It isn't what is the present price or yield of bonds. And it's not entirely the comparison between bonds for the long term and stocks for the long term. It's all about individuals differ. Every one of us has different characteristics as investors. Different amount of wealth, different amount of income, different amount of savings capacity, different attitude towards risk. And when you take all of those different things and a different time horizon, when you put all those things together, it makes for a very important way of defining who you are as an investor, and that's what should be governing your way of investing. So the fact that you are 30 years of age doesn't answer the really important question. What's the capacity of this individual? If it's somebody who's 30 and has a high school education and has a very modest level of savings capacity, that's a person that might very well want to do 30% in bonds. But if you were 30 and you had an MBA and you were on your way towards a really interesting career and you knew that you were going to be able to save substantial amounts of money, then you wouldn't look at that 30% as being anything like a sensible idea, because you're going to be able to save, and that creates an enormous property value. Then you're going to have Social Security, which is much larger than most people recognize. Then you're going to have a home, and that's a stable asset, but it does fit into your total picture. So what in the world is the reason for having 30% in bonds? There may be somebody in the world for whom that is the correct answer, but there are not very many. Certainly aren't everybody.
Yeah, I guess, Dave, to me, it's pretty simple. I mean, I agree with Charlie, but it's pretty simple. I mean, record low rates, even slightly higher rates we have now, has meant zero net return in bonds for a long time. I mean, I know there are periods where bonds outperform stocks, but what's the talk in the ETF community?
I think it's slightly more complicated than that. I mean, bonds in a portfolio have always behaved differently than an individual bond. It's very easy to explain a single treasury to anybody, but to explain what happens in a portfolio of constantly rebalancing bonds, that's a very different pattern of returns in a portfolio. And that whole portfolio responds very differently when you're at the lower bound, which is where we're at in terms of interest rates. So I think the reality is both that you're not being paid very well for taking on what is at least some risk, and also that it no longer functions the way we used to think about bonds functioning when the sort of base rate was 5% on the 10-year or something. So I think there are multiple things going on there that just make bonds a very difficult asset class to own right now. It doesn't mean that an individual bond can't still serve a specific purpose for somebody. I know plenty of advisors who are still building individual bond ladders for certain clients with certain needs. But the blanket idea that as an asset class, you can just put money in the ag and it will do a certain thing for you, I just don't believe is true right now.
Yeah. Charlie, your thoughts on inflation? Obviously, we've had some concern recently about inflation. Some sectors like growth stocks, tech stocks have been hit recently. The relationship between stocks and inflation strikes me as very complicated, but I wonder if you could simplify it in some way. So there's a certain expectation embedded in stock prices right now on inflation. I don't know what it is, 2% maybe, but if it goes from 2% to 4%, particularly suddenly, the market does move on that. Is that rational? Should investors expect some kind of higher return if inflation moves suddenly, particularly outside of a certain bound?
Sure. But it starts with bonds. If you look at bonds, you should always do an inflation-adjusted return on bonds. And that if bonds are not attractive, you're going to have trouble having equities be. If bonds are a bad bet because of inflation, the inflation is going to affect equities as well, and it will reduce the value of equity securities, no doubt about it.
Yeah.
But I must
Let me ask you Go ahead.
And those of us who think we know exactly what's going to happen to inflation usually find themselves seriously disappointed, often.
Let me ask you about zero commissions. I find this very interesting, and I'm wondering how it might change the calculus that active investing is worth it or not investing, because obviously for years, people like you and Bogle have been, Jack pointed out, that when you include net of fees and all expenses, that's where active management really falls down. But with commissions at zero and fees still high but coming down, does that start affecting the overall calculus? Is it less obvious than it used to be about being concerned about the cost of fees and commissions?
Actually, the chances are that it's being offset by the driving forces that make indexing so darn attractive, which are everybody has everything in the way of information at exactly the same time because of the extraordinary distribution of information that's taking place in the markets. And it is astonishing how much information is available all the time to virtually everybody who's playing. It's a little bit like playing cards with all the cards face up. The world has changed, and most of us are still living with visions or understandings that were formed years ago, and we ought to be revising. I love Kate's wonderful comment. When the facts change, I change my opinion. What do you do about yours?
Yeah. Dave, you're a student of this as well here. Does the fact that ETFs are driving costs down and commissions are zero, does that, I wonder if that, how much that still affects the whole idea that net of costs, active investing still isn't worth it. I mean, the calculus changes a little bit at zero commissions.
Yeah, I think what it does is, to Charlie's point, right, information is now sort of freely available, moves instantaneously. There really are no core informational edges. What I do think exists are structural edges, and those tend to be very thin, and they tend to be very transitory. What I mean is, looking at particular skews, say, in the derivatives market, or looking at arbitrage opportunities between venues because of time delay. Like, those things still exist. They exist in infinitely small amounts, and so therefore you have to run enormous volumes through those edges to create any value. But those things exist. That's not what we're talking about when we're talking about people positioning for their retirement account. So I think what we've done is move a lot of the available VIG, if you will, in the market to a fairly rarefied part of the market. And the core stock and asset selection that most of us have to live with in the world, I would agree with Charlie. I think for most people, focusing on low-cost, broad, diversified indexing is going to be the way to go.
Yeah. I'm going to have to leave it there. We've gone a little bit long, but we're with a man who's had a big influence on me, Charlie Ellis, over the years, and it's the first time I've had him on our air. So I wanted to make a special point about it. That is it for this week's ETF Edge. My thanks to Charlie and Dave. And remember, the new edition of Winning the Loser's Game, Charlie's great classic, the 8th edition, is going to be out tomorrow. You can pick that up in bookstores or order it online. We've asked Charlie to stick around, answer a few more questions for the ETF Edge podcast. That's also coming up, so remember to tune in for that as well. And remember, you can see all of our videos on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.